Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have CEO Simon Dealy of HIRE Technologies. HIRE trades on the TSX Venture Exchange under the symbol HIRE and on the OTC under HIRRF. The company is trading at 25.5 cents with roughly 63.5 million shares outstanding, or about a $16 million market cap. I'd now like to hand it over to Paul Andriola.
Great. Thanks so much, Trevor. Yeah, great to have Simon here with us today. Trevor and I had a chat with Simon probably about 2 months ago to get a good understanding of what the company does. So we're happy to have him here today to tell everyone else what the company's all about. Simon, welcome. Why don't you tell us what you can? I understand you have a presentation, so I'll hand it over to you, but let us know all about HIRE Technologies.
Yeah, Paul, thank you for that. Trevor, thank you as well. It's lovely to get the opportunity always to talk about the company and the great stuff that we've got going on here. We actually did just release our earnings today. We had some fantastic results for the company, achieving 146% revenue growth. Our organic growth was industry leading at 44%. So really fantastic results. The top line growth of the company is amazing, and we're really getting some great sort of creativeness out of the transactions that we're buying. HIRE Technologies as a company is focused within human capital. So there's really sort of three main pillars. You'll see me in the presentation talking about this, but it's the staffing industry, which is in huge demand right now, which is a big leader of where all that growth that I was talking about is coming from. Then there's the HR consulting, and we have that element because that's where staffing is trending towards. The companies are looking for their vendors to do more, trying to get more out of the people they engage with, and that's where the industry is headed. And so that's a piece that we're building as well. And then of course there's the SaaS technology side of things, and the tech aspect is sort of this whole the bricks to clicks aspect of the company, where it's a big disruptor to the industry. It's something that we want to embrace and be a part of, and use that to create a lot of recurring revenue, high margin recurring revenue for the business, but also to differentiate how we go about it. And when you think about sort of executing consolidation strategy, what you want is a very large market, heavily fragmented with not a large incumbent in the market. The staffing industry alone is a $500 billion global market, represents $150 billion in North America. There's 30,000 staffing firms in North America, and the largest staffing firm in North America has less than 6% market share. So it really ticks all those boxes in terms of a massively fragmented market, ripe for consolidation. And there's a way that you can do that to really get that 1 + 1 = 3, which is how we're executing, which is to really pull that, have a centralized back office, pull that cost, that SG&A out of the acquired brands, and let those guys focus on growing their businesses. And to that end, we've had the three brands that we bought in the last 18 months have grown. That's the Headhunters, Taylor Ryan, and the Caven Group, have grown anywhere from 30% to 160% in growth since we've acquired them. And that's really accretive to the bottom line performance of the company, because that valuation that we paid for has really been underscored by the growth that these guys are getting, that real high generation performance that they're getting in the business. And we are Canada's only public consolidator in this space. We're the only ones doing this, and it really creates a very unique opportunity to be a part of that growth story that we're driving here. And so, as I was saying before, the three pillars of the company being the staffing, the SaaS technology, and the HR consulting. Since we founded the company in 2017, went public at the end of 2019, we've been focused on building that staffing base of the company out. That's important to us because those staffing businesses have really large margins, adds a lot of good EBITDA to the business. And typically they're generating somewhere around, sort of, I guess, the 25-30% bottom line margin, which is great for us, especially when we start carving out some of that SG&A as well. So it's really accretive to us. And then we did do an investment into a SaaS technology in April, which is called Pulsify, and as our first SaaS acquisition. And the reason we did that is because this platform is it sort of answers that question about how do you manage a hybrid workforce. It's all about employee engagement. It's got a net manager score to ensure managers are effectively engaging with and working with their employee base, because you want to try and reduce the turnover. And there's a lot of talk right now about, now that we've got this hybrid workforce, about a high turnover, and that's very, very costly to businesses. So how do you mitigate that? And this platform speaks to that. So it's really bringing all those pieces together. And again, we're getting some fantastic results as a result of that. And I will say, as I go through this presentation, guys, that it hasn't been updated for my Q2 results, which only came out today. So again, some of the growth numbers and so on that I'm showing you here, I will give you some color onto what was in the Q2. And I would encourage you to look at the Q2 press release as well, because it will talk to the new numbers, the updated, sort of that momentum we built in Q1 continuing into Q2. And it was sort of, again, that trajectory going through into Q3 as well. So what makes us a unique acquirer within this space is that we don't rebrand the businesses that we buy. We want to keep the nicheness of the brand. Those businesses that we're acquiring are already being very, very profitable, driving good growth in their certain niche that they focus on, and being successful competitors against the larger incumbents like the Randstads and Adecos and Robert Halves of the world. So we want to maintain that brand. And those entrepreneurs, no, they didn't grow up dreaming of creating this company and then sort of selling it, becoming a regular employee again. So we let them keep that. So we put some corporate governance guardrails around the business that we buy. They keep that brand. We pull out of that business things like finance and accounting, HR, legal, those types of elements. Use our shared services to do all of that for them. And again, these guys just now focus on growing their businesses, but we also give them access to other solutions. So, for example, when we acquired the Headhunters last year, they didn't do any IT staffing. And so we have an IT staffing business called Provision. We could immediately start selling our IT staffing solutions into the Headhunters client candidate database. And so that was a great way for them to get access to another solution offering that they could sell to a clientele that already knows them and trusts them. For the Headhunters in particular, they are focused on putting in C-suite and board members into companies. So there's that trusted advisor relation at a very senior level that can now come to them and say, hey, look, our sister company can do other things here to help you. And it really helps generate that sort of accretiveness to the transaction. And then also with that Pulsify transaction I was mentioning, another tech solution as well, things that the clients are looking for, enabling them to get more from the relationship that they have with our brands. And also this is a situation where they can also expand their geography. So again, with the Headhunters being mostly West Coast focused, we can now let them get access to the East Coast and other clientele in the East Coast. So it's a really great way for them to grow. And like I was saying, you're seeing some pretty high growth numbers coming post-acquisition. So it's really accelerating that growth once we bring these guys into the fold. And that's what sort of differentiates us again from other acquirers out there in the market. So certainly, like I'd mentioned, like Randstad and Adeco and those guys, they do buy staffing firms, but when they do it, they will rebrand them. They will throw the brand out. They'll absorb the client base and the candidate database into the company. And those entrepreneurs are now more regular employees, and they're not getting access to the tech angle that we're bringing on as well. And they don't feel that sort of that continued ownership of the brand that they've developed. And they would necessarily have access to the sort of public company, same sort of public company things that we would give them access to. So that's access to the stock, the employee share purchase program, long-term incentive plans, those types of things. But it also enables us to lock in that next level of management. So if there's any sort of succession planning, we can lock that in against the private side of the world, which is what you'd see with the Vacos and Teamers there, where they are not necessarily aligned on an exit strategy that fits for these guys. They're private. So they're looking at their own exit strategy, how they want to build it out, don't necessarily have the industry expertise, and certainly don't have the public markets benefit to being part of a public company as well. So it really creates a great value proposition for the brands that we bring in. And it's been great because my deal pipeline has quadrupled since the beginning of last year as a result of doing these successful transactions, having these guys, these vendors going out there and telling other people, look, you should join HIRE Technologies. It's a great transaction for us. We're really getting a lot of value out of this. And so we've got a really strong pipeline of other transactions to bring in. And, you know, I recently announced that we're buying Leaders International out of Quebec. So, you know, that's another example of bringing that sort of high margin sort of revenue stream into the company. And that particular transaction, you know, it's a great example of that private to public company transaction there, where it's, you know, bringing paying for something at sort of the 4 to 5 times multiple, but trading much higher than that, and enabling us to really get that private to public company arbitrage. The types of clients that we have, again, it very broadly range because we have the niche brands there. They're known for something. So these companies gravitate to them for what their specialization is. It enables us to have that Fortune 500 all the way down to much smaller companies that we can service on any sort of scale. And interestingly, sort of looking at the dynamics of the market right now, there's a lot of US-based companies that are looking north of the border for their resources. Again, companies aren't always looking for the closest, best resource anymore. They've embraced that hybrid workforce situation. So they're keen just to find the right people, even if they are going to be remote. And that's really benefiting our databases of candidates in Canada who now aren't just sort of narrowed down to whatever companies are in their local geography. It's really opening it up and enabling them to be far more sort of competitive in how they're looking at the market for themselves, enabling us to provide clients with a broader range. So we are actually now servicing US companies, which is helping us as we look next for the next few acquisitions we do to be penetrating the US market as well. And again, that US market is very, very large. It's 10 times larger than the Canadian market. We've already been hugely successful in the Canadian market. So getting access to those US companies is obviously very important to us as well. What we're seeing here again is just a bit of an overlay to show you sort of peaks and troughs that comes out of a downturn. So typically, the staffing industry is a great bellwether of any economic recovery. You've seen that in the last couple of downturns where the industry itself is getting double-digit growth. Certainly, this particular downturn that we'd entered into because of COVID is seeing a nice sharp recovery coming out for the staffing industry, where we're getting our organic growth rates of 44%. It's just pretty good growth rate for the company, and we're continuing that momentum because of the high demand and the scarcity of the resources right now. So we've done quite a few transactions to this point, been very successful in the deals that we brought into the table, and again, really leveraging sort of that private to public company arbitrage I was talking about. So the deal structures, I'm sure you'd be interested in. How do we put these together? How do I get that return on the investment that we're making? So a couple of unique features there. We always get an underwrite on the EBITDA that we acquire. So whatever that EBITDA number is that we're bringing into the business, we ask these vendors to underwrite to guarantee us for a certain period of time that we're going to continue to achieve that EBITDA number. Now, there's a lot of different ways that we can have clawbacks and so on to ensure that that minimum is kept. But it's a great way for us to sort of shore up the return on that investment again. And we do split these typically between some mix of cash and stocks so that we are able to get them some skin in the game, so to speak, with the company, reduces my upfront working capital on the acquisition side as well. And then we do have a couple of different structures on like a TBE or a revaluations, other sort of short earn-out period post-transaction as well. Any stock that these guys take is locked up for a minimum of 2 years. So we have that advantage as well. And again, this paying 4 to 6 times, trading at 12 times is actually the industry right now. Staffing industry is typically trading at about 15 times. Really accretive for us to bring those into the business. In terms of the comparables and how we get those returns, it's actually, as you can see from the graphic over there, on the right-hand side, there's very little in terms of what we have to do to get at least a 10% return on an investment. Pulling that SG&A out alone gives us a huge bump on the bottom line of the acquired entity. And there's very little ask in terms of growth in order for us to get to that 10% return threshold. And then looking at some of our comparables there in the market, you've got the first few there, like the Randstads, Robert Halves and so on, other staffing firms out there in the market, see the sort of returns that they're getting right now. It's because the industry is growing. It's a really high growth area, lots of opportunities, and also a great way for us, any transaction that we bring in now, like that Leaders one I was talking about, which we're about to close on, is one of those situations where it's immediately accretive to the business. You're adding in $1.3 million of EBITDA to the bottom line. That is immediately accretive to us in terms of the growth that the industry is getting, and also that private to public company arbitrage I mentioned. In terms of the executive team that we've put together here, and really, as you'll see, for the executives and the board, a lot of specialists, people that really know consolidation strategies, they know capital markets, they understand what it is we're pulling together. For myself, originally from Australia, so that's where this accent is coming from. Worked in banking and finance, worked at various law firms in Australia, where I did M&A and due diligence there. Moved actually to the US back in 2000, worked at KPMG, and I did business process redesign and change management for Fortune 500 companies on a global scale. Ultimately got headhunted and was running a consultancy for a public company out of Paris called Altran that I did a management buyout of with two other business partners of mine. And we grew that to operate in 35 countries around the world. And then I sold that to a public entity in the US. So I've been on the other side of the desk and know the sort of the challenges that these guys are going through when they're going through selling their company. It's going to be very empathetic to them to that. And then ultimately was one of the founders of HIRE-TSX.V back in 2017. Eric, who's my chief legal officer, formerly with the TSX, understands all on the legal side of things, where the compliance efforts that we have to go through for being a public company, the deal structures we're putting through, has a really deep understanding of what it is to be a public entity doing the sort of consolidation strategy we're doing. Dan, who's my chief financial officer, did exactly the same thing here that we're doing with Dental Corp. So Dental Corp, we're very, very successful in building that out on a consolidation strategy as well. On the board side of things, I'm really proud of the board that we've put together for this company. We've got Sean Cleary, who did this with People Corp, same consolidation strategy there. Hamid is doing this right now with Well Health Technologies. Johnson, who's my capital markets partner, very familiar with how to raise capital, pull things together for a public entity. And then I have Sunil Sharma, who's an advisor to the board, who heads up Techstars out of Toronto. So that's my conduit into all that is SaaS, all those other sort of technology companies, and advisor of how we would put our tech deals together. And that's sort of the pipeline for what we want to bring in on that side of the business as well. Now, these numbers here are a little bit out of date, only because, like I said, I released the quarterlies today. But again, on that growth, all on the positive on what you're seeing here right now, that CAGR continues to be very, very high for us. Really good margin performance. The really marked improvement on the margins that we've seen since this time last year. We continue to have a great mix between our permanent placement and our on occurrence or permanent placement and our contract revenue side, so the recurring revenue side. And it's great to have a good base, 72% is what it is today, of recurring revenue in the business, because it gives us great predictability of that revenue, what's coming into the company. But then we're layering onto that very high margin permanent revenues as well. So it's nice to have that mix. And as we saw when we went into the downturn because of COVID, the contract revenue book, or that recurring revenue book, continued to hum along, because companies were less likely to bring in full-time staff. They wanted to use the contingent workforce for that. And it positioned us much better against companies that only did permanent placement, because we kept the revenue going. We let our clients convert these guys to full-time, so we get a permanent placement fee. And then also we're blocking out any competitors that only do permanent placement. So it's great to have that mix. And now we're layering onto that the SaaS technology revenue as well, as I mentioned with the Pulsify acquisition. EBITDA performance has vastly improved. And in the last quarter, we'd made some investments. We did investment into Pulsify. We've made some investments into our shared services, so that we're really scalable now to add on a lot of other entities onto the business without having to add a lot of any cost structure to the back end as well. So it really sets us up beautifully as we continue to execute on the high growth that we're achieving today. Unfortunately, the cap table, again, a little bit out of date, but we're very happy with how we structured the deals. We are trying to put the deals together that we're raising capital right now. We're doing some mezzanine debt as well, so it's not dilutive to the existing shareholders. Go through this process of always trying to be iterative and adding value to the shareholder base. And I certainly feel, especially today, where the share price is vastly undervalued against what the revenue generation that we're having on the company, the positive numbers that are coming out of the business. There's definitely feels like there's a disconnect between the great fundamentals that this company is producing and what that share price says today. So it's a really good opportunity to get ahead of the trade, so to speak, and see the value that we're generating within this business. So that's my presentation to you guys today. I'd love to take any questions or thoughts that you have.
Perfect. No, thank you so much, Simon. I'm going to remind everybody that's listening, if you got some questions you'd like me to ask Simon, just use the chat function and I'll do my best to ask the question. Why don't we talk about sort of the go forward as far as your M&A strategy? What do you sort of look for more? Are you, because you've made a technology acquisition and you've made sort of call it competitor acquisition, are you looking for more of the sort of technology that you can add to the sort of the selling stack, or are you looking for relationships and geographical expansion?
That's a great question, Paul. I would say right now for us, it makes a lot more sense to bring in more of the high EBITDA numbered staffing companies into the business, because I want to build a bottom line for the company that is, again, positive EBITDA, positive cash flow against the high growth rates that we have. You'll probably see us executing transactions next to penetrate the US market further, because once I have that much broader based staffing footprint, you imagine, you think about this, I've got a lot of clients already. I'm increasing the number of clients that know and trust us, and then I layer onto that the tech. So that's what's happening right now with Pulsify. We're able to introduce that to our existing client base so they could start to use the product, get familiar with that, and then I can further expand it. So every time I add on SaaS, even if it is sort of at that break-even point, maybe it's got good ARR, but it's not, but maybe it's a break-even business, I can do that without it being a drag on the company, and I can immediately really accelerate their go-to-market strategy, which is exactly what we did with Pulsify. I mean, Pulsify, two great investors came across as part of that transaction. Frederick Kirst, who was one of the founders of Okta, and Damesh Shah, who's a co-founder of HubSpot, are now shareholders of HIRE Technologies as a result of that transaction. People that I have access to talk to about other things that I'm executing within the business. And that's the sort of thing we're trying to do, is bring in really good product, use that to differentiate us in the market and be a disruptor to the industry.
So, I mean, you mentioned Quebec as one of the acquisitions you've made. Geographically, where are you guys strong, and where would you like to be stronger?
Yeah, we have now a footprint coast to coast in Canada. So we're operating in all the major centers within Canada. There probably isn't, in terms of geographical footprint, another area that we really would need to penetrate within Canada right now. Again, we've got all the hubs there covered, and so that's why I'm saying, maybe it's more of a specialization. There might be another type of, another executive search solution or something like that we'd bring into the company within Canada. We're covering heavy and light industrial, IT, finance and accounting, legal, marketing. We've got all the solutions covered, I think, pretty well. But there may be some expansion of those solutions in other areas. So it's really that US piece which is next. And so part of the strategy for us is to be very opportunistic about any accretive transactions in Canada, but actually execute some transactions in the US to expand that footprint. And then you'll see us do things like get the OTC listing, get DTC eligibility, get the OTC listing, and that will give us access to the non-accredited retail investors in the US to further improve the liquidity and volume of trade on the stock.
Gotcha. Now, give us a sense of your current platform, what you have right now. How much capacity do you have to grow without any significant sort of investment in people or other systems you have? What's your current sort of run rate capacity?
Yeah, so we could double the size of the business without adding anything meaningful to the back office of the company, because we use a lot of scalable IT platforms that we run on. So for the ATS, which is what the applicant tracking systems that the staffing companies use, we use Bullhorn. That's one of the largest, if not the largest, ATS for staffing companies, easily scalable from where we are right now. All of the other systems that we have are cloud-based, fully scalable. And in terms of headcount, we're pretty anemic in the back office. We don't want to add a lot of headcount there. So it's really more on what we can service. And again, we could essentially double the size of the business without having anything meaningful happen. So we really have hit that that plateau point that we needed to build out, which is what we did in Q2 of this year. So we can add on these other acquisitions without adding a lot of cost into the company as well.
So, I mean, you grew organically by 44%, I think I read. Try to break down where did that come from? Like, is that just efficiently selling additional services, or is there some just market growth there, or how do you describe that 44% growth?
It's really interesting because if you look at us with the peers, we are a positive 16% against the peers in the industry on the peer ratio. So the reason for that is, I believe, there was a lot of untapped potential in the client databases that the acquisitions brought across. So these guys were having to do a lot of running the business. You know, they had not just the selling, but they had to deal with making payroll, financial reporting, dealing with all that minutiae at the back office. Now we've said to them, look, that's all done for you. Don't worry about that anymore. Just tap into these relationships you've got. You've built great relationships. Focus on that. Just do that. And they're now laser focused on that, and they were able to grow because of that. And again, great benefit of the industry is getting such a fantastic recovery right now is that's exponentially helping them grow their business. Taylor Ryan grew 165% over last year. So it really speaks to what they were able to tap into. The Caven Group, I think, was 75% growth. I mean, everyone's getting great growth numbers. And the best part about it for us is I bought these companies on an EBITDA that was at that lower level. So my valuation, my cost of acquisition has come down because these guys are really accelerating their growth.
What sort of, COVID has changed a lot of industries. What's it done to your industry, and what does it look like going forward?
I think the biggest impact for staffing is really the fact that companies before never would have dreamed that they'll be onboarding or employing people through this sort of means, doing video interviews and so on. It's made it vastly more efficient for us to execute for our clients because now they're so comfortable doing it this way. Certainly, as we continue to go through the vaccine process and people getting back out there again, it will probably end up being there'll be some face-to-faces towards the end of the process, but that whole process is vastly more efficient than it used to be. The other thing that's changed is that companies now are much more open to recruiting outside of their immediate geography. They're not looking for someone to have to come to the office every day. So they're more willing to, hey, I need the best person, not the closest best person. And so for some of our databases of the brands that we have that were more regionalized, they've now found that they can, they're in Calgary, but they're using they're sort of bringing their candidates to Vancouver and Toronto and so on. It's really opened up the potential, but made that database of candidates vastly more valuable to them as well.
Now, earlier, I think you mentioned the number of 72% as far as recurring revenue. 72% of your revenue is recurring. Maybe break that down a little bit more. What is it that's recurring, and where does that go in the future? Do you expect that to go higher? Do you expect it to go lower? What can you tell us?
Yeah. So by design, typically, I want to keep the recurring revenue piece around that 70% range because it's got great predictability to it. It enables us to even out sort of ebbs and flows of the economy as it cycles through. And also then layer on that 30% of permanent placement helps reduce the seasonality because you'll get some slowdowns. Happens a little bit in the summer, can happen towards through the holidays at the end of the year, sort of smooths all of that out. The recurring revenue for us right now is primarily what we call our contract staffing. So that's companies using us to supply a contingent workforce to them. So we'll employ the individual and on-bill them to the client. Now, I don't have to worry about the deliverables or the management of that person or providing the hardware or anything. I will pay that hourly person whatever their hourly rate is. I'll put a markup onto them of somewhere between 25 to 35%. And then sell that on at that rate to my client. So for example, Scotiabank, we're the second largest provider of IT services to them. They come to us, we give them the people that they need, and then they'll just pay us on a monthly basis for the hours that those guys build to them. So, and those contracts are anywhere from 9 to 18 months. So again, great predictability on what you're going to get on that revenue stream.
Fantastic. Your balance sheet. I mean, you're partly an M&A story. What's your balance sheet look like, and what, if any, sort of short-term capital requirements you need to continue to do what you're doing?
Yeah, so I think we've actually got a really strong balance sheet. Certainly, I'd always want more cash in the balance sheet, which is why we're doing a capital raise right now. Again, that's likely to close very soon as part of the acquisition that we're doing. But yeah, I think as far as the working capital on an ongoing basis, we're fine. We've got a great line of credit with TD Bank. We have, I think it's something like $3+ million or maybe it's $4 million now of receivables that we can leverage with TD Bank. So it helps us on our peaks and troughs of the working capital there. And for us, it's always, I mean, we're an acquisition company, so we're always going to be looking at ways to go back out to market, look for creative ways to raise capital for the next deal. It's always backed up against just-in-time financing, as many other companies have done in this space as well.
Now, your board is quite, I say quite accomplished for the size of the company that you have. How did you, and there's a name on there that we're very familiar with. Hamid is a good friend to the small cap discoveries community here. How did you attract a board like that? How does a company like HIRE, attract these guys?
I'm a great talker, Paul. That's how I do it.
You're a great salesman, exactly. Yeah.
Great salesman. No, it's thank you for asking the question. So it was a situation where I was approached about. I tried to solve my company. I did some consulting, and then I was approached. Hey, look, would you like to do the same sort of consolidation strategy up in Canada? I already had operations in Canada in the past. I really like the Canadian market. I'm like, yeah, I'll absolutely like to do that, but I need to know that we can have the right sort of access into the subject matter expertise around us. And so I was originally introduced to Sean Cleary, who was the first person I spoke to about coming onto the board. I saw what Sean had done with People Corp, and a very no-nonsense guy. He understood it. He knew, be very sophisticated about it. Don't, have a good plan, a good approach to it. And that's so I asked Sean to be on the board, and he obviously agreed to do that. And then Johnson's son, who was on the board, said, hey, look, we should talk to Hamid. He's doing a very similar thing with Well Health Technologies. And so I knew of Hamid because of the TO transaction that he had done. So I flew to Vancouver, and I got to sit down with Hamid because he knows Johnson. I explained to him the market, sort of the fragmentation of the market, the potential that we have there, the fact that I've done it before with other companies, and that had so many parallels to what he was doing with Well Health. And he got really excited about it. It's like, yeah, look, this is great. My company was sort of where that was going to be about 4 years ago. Yeah, this makes a lot of sense. You're kind of going to be like the baby well. So, and I don't mind that being pasted on us. I think that's very true. We've done a small SaaS transaction now, very similar to what Hamid did. We have a lot of fragmentation in a massive, massive market. So it's all about being very sophisticated and being mindful about how you bring those acquisitions in, and making sure they're all accretive to what we're building, which is why, again, you're seeing the high growth numbers that we're achieving today.
I think you said in your presentation, insiders own 19% of the company. Is that correct?
Yes, that's right.
Yeah, maybe give us a sense of who else owns the stock. Do you have any institutional ownership that you can speak to? Just a general feel for who owns the rest of the stock. Yeah,
so that's a good question. I guess I don't really have a good feel on. I mean, most of the stock that I've got is on the retail side. I do want to do a much larger institutional round. I did attempt to do that actually at the beginning of this year, but the market just was too soft for us to make that happen. So it's mostly on the retail side. I've got the likes of Canaccord and Gravitas and other institutions involved in that respect, but it's really the next iteration. So I have a AIF filed. I'm ready to do a prospectus raise, but I'm going to go through and do some transactions, really show the build up on what the company's doing, even from this great platform we have, before I go ahead and do that. And again, that prospectus raise is where I intend to bring in some pretty well-known institutions as part of this story here.
What are your biggest challenges? What sort of, that question, what keeps you up at night?
Well, it's a funny thing because I kind of feel like there's for me, it's always, the businesses are running themselves. I don't buy these entities to have to run them directly. I've got great leadership in the company. We've got these guys locked in, and the businesses are performing exceptionally well, as I was discussing. So I don't have to worry about that necessarily, but I do, I know I need to do much more promotional efforts to the market at large, the capital markets, because again, if you've got it's such a great story on the performance of the company and the fundamentals that we've built, but that's not being reflected on the share price. Obviously, there's a disconnect there. That would be the thing I have to work on the most. That would be the thing that I'm focusing on the most right now.
I'm going to take one of the questions that have come in right now. Can you explain, or can you please expand on your technology advantage over your competition? What do you offer or implement that an Adecco cannot?
Oh, it's a good question. So primarily the Randstads, Adeccos, and Robert Halves of the world aren't trying to build a SaaS platform angle to their businesses. So they're going to stay, not stay, but they are focused just on the staffing industry. And what we're doing is we're adding on the technology, because there's this shift in the industry. As I'm mentioning, you're seeing staffing become much more consultative. I used to run a consulting firm, so I know there's a great advantage to us to build out that consulting part of the company. Is very high margin, 50+% gross margins on that work. Plus, it gives you a different seat at the table within a client. So it's very important that we build that, and the technology becomes a differentiator. So that's the thing where companies they always see it, and you've been seeing it during the pandemic, where they're looking to try and do things differently, to try and be much more efficient, reduce their labor costs. How do they do that? Going to do that with tech. And so we are looking always for that. What's the thing that's going to put a staffing company out of business? What is that? Or what is that big value that a business is looking for from a staffing company? And so that's why we bought Pulsify, because Pulsify provides a cloud-based, very, very scalable platform that enables companies to do performance reviews and task management, and ensuring alignment between employees' expectations and a manager's expectations, creating a net manager score so that companies can ensure that they're being effectively connected to the company. So it might be a little bit anemic in terms of the fact we've only got one platform now, but we are going to be building out multiple platforms there. Again, onboarding and offboarding. How do you onboard and offboard remote workforces? Then you've got psychometric testing. How do you ensure that the work style performance of an individual aligns to the culture and work style performance of the company? Those types of things. So again, we are going to be building that out. It creates a differentiator. So now you're not coming to us just to get certain positions filled, but now it's a holistic solution. It's more broader than what it is. And it creates a great way for you to become that trusted advisor to the client than just being that sole source for one thing.
Where do you see the company? Where do you see HIRE Technologies in 5 years from now?
It's interesting because of the size of the market potential. Now, if we only operated continue to just Canada, that's a $15 billion market. And we've already managed to grow the company exponentially from when we first founded in 2017. That growth rate, there's no reason why that growth rate can't continue just on the back of the acquisitions we're doing, even putting aside the organic growth of the industry right now, because of the massive fragmentation. I mean, I have lots of companies come across the desk that we get to choose from and how we're going to bring it in. So we will expand the company into the US, as I've mentioned. That will happen pretty soon. That we'll start to do that. It could just be a North American company operating in a $150 billion North American market, but most likely 5 years from now, this is, a 10x of, and I'm not exaggerating, that could be 15x of where we are now, because we will be able to easily penetrate into the European market and Asia Pacific market. I did this with my staffing company, with my consulting company. You get a pull from your clients to do those other markets. There's a lot of growth going on in Europe that we can take advantage of, a lot of growth going on in Asia Pacific we can take advantage of. Easily, this is a global brand 5 years from now at much higher levels than what you're seeing today.
So as investors, what sort of catalysts or what should we be watching for to know that you guys are executing on your business plan?
Things like what we're doing with this Leaders transaction. We're adding another $4 million of revenue to the company. Reported. I mean, these guys are still experiencing, if you understand the growth rates that are happening in the industry right now, but we're adding $4 million of revenue, $1.3 million of EBITDA. that's a threshold moment for us alone, because it's obviously pushing us into a positive EBIT, a positive cash flow situation right off that transaction. And then every time I do a transaction after that, it's all accretive. It's all adding to that bottom line, adding to the top line growth of the company. And all of these transactions, I am pulling out that SG&A cost and creating this sort of this churn for them to really drive the growth of their businesses. So it's that continued baseline of these acquisitions. And I think probably the next, then when I do my US acquisition, that's also another big inflection point for the company, because now I've got that penetration into the US market. It's really going to help us offset this pull that's happening right now into that market, and it will really help accelerate the investor, sort of that non-accredited investor push with the OTC listing. So that's some of the near-term, very, very near-term catalysts I'm talking about. And then it's, looking at sort of getting exponentially bigger in transaction size that we're doing. I mean, we're playing right now between that sort of, $4 to $10 million range of revenue, but there are thousands of companies in that sort of $20 to $50 million revenue range that we are looking at. And that helps us get that snowball effect to really start making significant gains in the industry and growing the company.
Fantastic. We're near the end here. We always like to give the presenter an opportunity to just sort of give a key takeaway or a key message you want to make sure that everybody walks away with today. Simon, what do you want to make sure that all our listeners walk away with today?
I believe wholeheartedly, very strongly, that our growth that we've achieved in the first half of this year is going to continue. The industry's showing it. We're getting above industry average growth rates. We've done exceptionally well to build a great platform for the company. There's a big disconnect right now between the valuation of the stock and what the company is doing. This is the time to get involved with HIRE Technologies, because I have this pent-up list of acquisitions that we're going through right now. We'll be bringing online. It'll be a great time to get involved with the company, and we've got the right people around it to really make this be a successful story.
Fantastic. Listen, if somebody wants more information, what's your website address, or what's the best way they can get more information on the company?
Yeah, HIRE.company is the website address, and I'm always welcome people to email me directly as Simon or sdealy@HIRE.company. Always happy to talk to investors and potential investors.
Fantastic. Listen, we've been speaking to Simon Dealy, CEO of HIRE Technologies, symbol HIRE, on the Venture Exchange. Simon, great to catch up with you today, and we really look forward to catching up with you in the future, and continued success. Looks like you've got something, you've got some pretty good momentum here, so continued success.
Thank you very much. Thanks for the time, guys.